Yeah, we've been just informed that the Christmas has been pretty much cancelled in Europe.
Yeah, I wrote a whole article about this. I knew it was coming.
Yeah. What business consequences of the usually strongest holiday season do you expect?
Look, Europe's already been slowing down with economic growth, and now this makes it worse because, you know, if you think about Christmas, you're less likely to order something online to send it to your family because Christmas is all about exchanging gifts by hand. And so I think it's going to hit everybody. And don't forget all the New Year's Eve parties.
Yeah.
They're not going to happen this year. They're going to ban them.
Hospitality business.
Yeah, it's tough. It's going to be tough, and it's not going to get any better probably until March. You know, the UK, I think, will remain in lockdown. Most of Europe, I think, will remain in partial restrictions easily until March, until they get it back down again. But they learned from the summer that they can't reopen because it comes straight back up. So basically, you have to have these rolling lockdowns until you can vaccinate everybody, and that's not going to be until September.
In terms of GDP, is it going to be a bigger hit than spring?
No, it'll be a lesser hit, but it'll keep going on. The problem is we had the fall, it came back up, and now it's just going to be lower for longer. So it'll be if you think of the financial crisis, that recession, you know, most people saw maybe 1 quarter, 2 quarters of negative 4% or so. I mean, this is probably still negative 5%, and it's going to continue for another few quarters. So we've never seen anything like this.
Yeah, we haven't. Is the K-shaped economic activity already certain? And is it going to be followed by the L-shape?
Yes, I think or maybe a T-shape, you know, with a lower T where it's halfway down. So we have a big drop, we come back, and then we flat line around -4, -5% for several quarters before slowly recovering again.
Mm-hmm. It feels like we live in a very confusing times as regards to defining economic reality. Is it just me, or the institution are pushing one narrative, the mainstream media another kind of stories, independent free market capitalists a third one? What is your take on that?
I think you're dead right. There are different narratives because we are living in very fragmented times. So different people are pushing different narratives for different purposes. So we've seen the narrative of the stock market where everything looks okay. But the narrative of your friends and my friends who run businesses and restaurants and hairdressing salons, they're not okay. So the average person is not okay. The governments have been kind of claiming it's okay because they don't want to admit it. The central banks have been saying we should be fine, meanwhile printing enormous amounts of money, which tells you that they don't think it's fine. And then others have been talking about the insolvency issues that are outstanding. And then the central banks have also been stopping insolvencies in large companies by buying their corporate credit. So we've got this really weird market where there's no real signals and everybody's lost. Then everybody's fighting over economic restrictions versus non-restrictions over the virus. Everything has become political. I mean, literally every single thing. So there is more noise than there is signal. And I think everybody's struggling with that.
What would be your quick economic overview?
My economic overview is that I've thought that this will play out in 3 phases that I call the unfolding. The first phase was the liquidation phase that we saw into March. That's the, oh my God, everything's changed, sell everything. Mm-hmm. Then is the hope phase where people think it's going to be okay, this will go away. And then there's the reality, which I call the insolvency phase, which is what's exactly happening now is that the economy doesn't recover because the virus doesn't go away. The economic impacts are much longer. And the insolvencies, starting from the bottom, from the small businesses, rise through the system. We've seen the banking system in Europe under pressure from that. It recovered in recent days with a bit more hope, but it's been under pressure. We've seen bond yields come lower, of people have realized but this is going to go on longer than people expect. So my view is, I don't look at what the stock market's doing. I look at what the bond market's telling us. You know, if you look at bond yields in Europe or bond yields in the US, they're falling and they're expressing concerns about the economy. Bonds tend to tell the truth, while equities tend to tell emotion. So I listen to the bond market more than I listen to that. So I really think this is a much more concerning situation. You and I were talking before about Christmas and the economic hit of Christmas and New Year. As you know, in Europe, it's a very big deal. Now, Europeans are generally a collective bunch, so they understand generally that society sometimes needs to sacrifice. So they will do it. And yes, there will be some, unrest, but people by and large do it for the good of society. But that has economic impacts. I mean, there is no way out of this, because if you don't do it, the death toll rises and people stay at home anyway. So, we've seen that. We saw it in Sweden versus Spain, one hard lockdown, one no lockdown. What happened was the Swedes stayed at home, same economic impact. So in the end, we just have to get through this.
Aren't the governments doing enough?
No. Problem is they can't afford to. I mean, really, this is the time for fiscal stimulus. You have to give. You shouldn't be helping those large corporations with big debts like General Electric. That should not be the job here. The central banks are doing that. We really should be helping the hairdresser and the restaurants and the local cafe and the local small businesses. Yeah, you can't stop retail in the high street because that was going away anyway. But people being penalized for something that is an external event, that's not because they took on too much debt, not because they were speculating, just because as a society we've had to take certain actions. Governments need to do more. The problem is how can they? They're already massively in debt. And we've seen, yes, the central banks have to monetize that debt, but that has its own unintended consequences, because we already came into this with enormous debts.
Yeah.
So it's a problem. We've seen Italy over the weekend saying, well, they want to be forgiven for some of the increase in their debts already. And normally this kind of talk doesn't happen for another year or so after the crisis has started. So yeah, this is going to be bad.
Mm-hmm. Do you expect another debt forgiveness conference like it was like 100 years ago?
In some way, shape or form. I mean, we're hearing it from the IMF. We're hearing it from various other places that there's a move towards the central bank digital currencies, a move towards a new Bretton Woods. We've heard the ECB and others, particularly the IMF, talking about maybe if we were to, let's say, create a globalized currency that everybody could print, let's say, a random number, 50% of GDP all at the same time to fiscally stimulate. And because everybody does it at the same time, then you're not devaluing against each other, you devalue against gold and crypto. So listen, I think there's going to have to be a grand bargain somewhere, because if not, what's left for anybody's children? What life is left when everything is bankrupt? There has to be a solution at the end of this. We knew that was coming in 2008. We were really sure it was coming in 2012 when the European crisis hit. Now we're in the big one. That something has to change.
In the phase of phasing out of the globalization or its trends, do you realistically see the three centers of the world to come together, meaning the United States, China, and European Union, to come together and pull this off?
It depends. It depends how big the crisis is. And it depends, I think, on one factor. And it doesn't look like it right now, but if the dollar was to go back up again, then I think it would force people. The dollar is the thing that nobody can bear. That the US is 25% of world GDP, yet 80% of all trade is done in dollars. There's simply not enough dollars considering all the debts. And this is the real underlying problem here. It's that kind of dichotomy. Everybody knows it. The US obviously doesn't want to do anything about it, but it will do if the dollar's too strong, like the Plaza Accord. So somewhere within a crisis, whatever format that comes in, now we're in the middle of one now, but how bad it gets, that's when things can possibly change. Or we splinter into 3 blocks. That's possible too.
Richard Werner is calling for the end of the damaging negative interest rate policies. What is your comments on central bank policies? Is there a non-dramatic way out? How far are we from central banks starting buying shares?
So I saw that when Japan went negative, which was the first, the Japanese bond market had gone negative beforehand. The free market had taken it there, not the central bank. When Euribor went negative, when the ECB went negative, Euribor had been negative for 18 months. The bank, same in Sweden, same in Denmark. In the UK, it's negative. First time in 500 years. So the Bank of England will cut. I don't believe that the central banks are the key influence in the interest rate markets. So many people believe that they are driving them lower. I think it's driven by debt and demographics. And I think it's inescapable for the United States too. I think it's coming. And I think that the central banks may well even use aggressive, like the Swiss have done, aggressive negative interest rate policy to try and create velocity of money, to try and get money out of savers' hands and back into the economy. I think they're going to try it because the market will have taken them negative first.
But does it work?
No.
No.
No. Doesn't work. And not until they solve how to, I mean, the next phase is obviously monetary stimulus financing fiscal stimulus. The central bank digital currencies allows that to be one whole mechanism directly. So that if I'm the ECB, I can give you money directly because I think you need money and that person needs to have negative interest rates. They can do all of that. That's to come. But I think the next phase towards this is the MMT movement of, fine, let's just try that. For no other reason than nothing else works.
Why is the credit creation theory so it just keeps being avoided by the central banks?
In what respect?
In terms of, you know, the window guidance, the things that were actually in place in Japan before it got into the 90s troubles.
Yeah, I don't know. I don't know. And I'm still not sure what the answers are. And I think Japan, when it was using guidance, had a banking system that functioned. We don't really have a European banking system, or the US banking system functions somewhat, but if we look at velocity of money around the world right now, it is below 1 in every single major economy outside of the US, which is 1.2. So it's basically telling us the monetary mechanism is now broken. So even window guidance to say lend to those industries, not to those, or whatever format, I don't think it works because the banks can't. The only way around it is if the central banks give the money directly, or the government does.
One of the things 2020 might be remembered about is the profound disconnect between the financial markets and the economy. How long can we continue like this?
It troubles me a lot. And the answer is I really don't know. I mean, many of us have kind of thrown our hands in the air and said, well, equities are just a function of central bank printing now. I don't know, because it's also dangerous to make that assumption if you're wrong. Because, you know, this feels a lot like the 1930s as well, and equities fell 90%. I mean, don't forget, in Eastern Europe, whether it was Bulgaria or whether it was a whole number of countries, saw their equity markets fall 90%. We saw Cyprus fall 99%. So, I'm not sure. So I don't trust the signal. It makes me really nervous because, again, if we talk about an aging population, if people suddenly think, well, equity markets are the safe haven and they're not, well, that's a catastrophe.
How different are your investing activities today compared to your Goldman Sachs days?
Well, when I was at Goldman Sachs, I was writing about and talking to clients about these very issues then. The pension crisis, they were all coming, the debt crisis. So I've been following this narrative, and I switched my entire pension, all of my pensions from my days of working at investment banks, I switched them all into bonds in 1999, 2000, and I've never changed them back again. And it worked very well. Bonds have done very well, particularly, I was living in Europe, so versus European equities, bonds were phenomenal bet. So that hasn't changed. It's become more urgent now to think to the future as opposed to protecting what I thought was coming. We've now hit what I knew was coming. And now it's like, okay, what do we really do from here? So my asset allocation has changed dramatically. I also am much less interested in equity markets in developed countries for the reasons we talked about, but I'm starting to look forward into emerging markets and other areas of opportunities as well.
Assessing the risk in the money flooded market, how difficult is it?
Well, as we discussed, almost impossible. That's why I still like bonds, because I don't think you can generate inflation, but there's not a lot of money to be made. Maybe in the US, they can go from 30-year bonds or 10-year bonds are at 85 basis points. Maybe they go to -20. Okay, that's a decent trade. It's not really an investment, and that's the problem. And we'll come on to crypto and other stuff later, but that's a big problem.
What is the commodity market situation? Is it really going to take another 3 to 4 years after the recession for the prices to recover?
Yes, I think they're probably in a bottoming process, but for commodities to recover, the dollar has to really weaken. Now, the dollar's at the bottom end of the range. Maybe it breaks lower. I actually don't think it does. Normally, commodities bottom after the recession. So if I remember in 2000 recession, silver, for example, really started taking off in 2003. Oil started taking off then as well. They all bottomed beforehand, but they didn't start accelerating till later. So whatever we're seeing now in commodities, copper is slightly different, I think, but I think it's a process. It's a bottoming process as opposed to a clear buy signal yet.
Let's say one of our 40-year-old listeners has 30,000 euros of savings at a bank, which she won't need for 20 years. If she leaves the money there, it will lose half of the value in 20 years. Where would you advise she invests money right now?
As a 40-year-old, if you're a 30-year-old, I'd say invest in yourself, start a business. You'll get a higher return on your investment than anything else, whatever that business is. Because if you were to put that 30,000 euros, and let's say you want to start an artisan bakery, you can probably generate from that 30,000 euros, 30,000 euros a year. It's 100% return. People don't think like this. Yes, it requires effort. So you have to factor in your time. But at 40, that's exactly the difficult age to decide, okay, what is it? Problem is there's negative return in banks, a probable negative return in the equity market, in the developed equity market, and bonds as well, and credit. So real estate generally will work in this environment over time, and maybe a recession is a good time to buy real estate if you've got cash. It's probably a good time to get debt if you are 40 years old, because if there's debt forgiveness coming or inflation at the end of it, debt gets eroded away. So buying a property is a good option. Or if you want to set it and forget it without managing it, then I would say emerging markets are a pretty good place to be, considering so many of them, particularly around India and all of the countries around, whether it's as north as Iran, if you want to be risky, as far across as Morocco, down to Indonesia, Malaysia, all of those countries have like average ages of 30 or less. astonishing. So, and they have low debts, high savings, right? So that is the opposite of the world we have in the developed world. So
I presume you have ETFs in mind.
Yeah, ETFs in India or some of these countries, and I think that will do well. And if you also, I would also allocate maybe a little bit to gold. I think you will get a commodity cycle at some point, but gold is fine, that will work. And then a bit to cryptocurrency as well, because I think that's the future.
And what would you advise to those fully invested in the stock market right now?
I would suggest, if you want to remain fully invested in markets, I don't like it. I don't have it. I'm very cautious in that respect, but taking much bigger risks elsewhere. I would say, fine, just think about where you own equities. Look for those growth countries, switch, think about changing your allocation over time to those higher growth markets that have been stable, have not really gone anywhere for a long period of time. If you look at the MSCI Emerging Market Index, it's basically traded sideways in a kind of wedge pattern for the last 24 years. Now, when that breaks, these things are going to triple, quadruple. So there is an opportunity if you like that kind of thing.
You mentioned crypto. You are probably already fed up with the next question, but anyway, you recently announced one Bitcoin to reach $1 million. When? And based on what assumptions?
Yes. So I've come at this in a number of different ways. One is there's somebody you can find on Twitter called Plan B. He's an anonymous who actually works for a family office in Holland, and he's a quant. And he analyzed a stock to flow model, which means they look at the amount of supply over time of an asset and how it affects price. It's scarcity, essentially. It's the same way that gold works, diamond works, things like that work, rare assets. And it becomes relatively predictable, interesting enough. That predictability would suggest that we might get somewhere like $1 million by 2025, 2026. Then we can use the logarithmic scale and look at the price of Bitcoin on a logarithmic scale. It kind of gives you the same price projections. Then the other way of looking at it is looking at the total amount of above ground supply of gold and its price, and then do the same for Bitcoin, and you get something similar. Basic charting techniques give you something similar. So there's a number of things that suggest that. But at a more sensible level, $1 million is it going up 100-fold from, well, it's now gone up to 20,000. So it's going up 50-fold from here. So Bitcoin's currently worth about $300 billion in market cap. So that's saying, okay, Bitcoin's worth $1.5 trillion. That's still only 10% of gold's market cap. Oh, sorry, not 10%. That's about gold's market cap, sorry. That's about $15 trillion. Gold's $11 trillion. So it's saying Bitcoin will be the same price as gold. Now, where's gold going to be in 5 years' time? Probably double or triple from here. So Bitcoin's going to be somewhere like 25 to 50% of the market cap of gold at the same time. So that's not unreasonable. So all of these things come together to say, it sounds crazy, but they all kind of add up.
And what are the supply-demand circumstances?
Well, yeah, it's fascinating.
For that, yeah.
I mean, basically, supply is restricted, algorithmically restricted, so it can never be changed. So you always know what the supply is. So then the question is, okay, what is the demand? Well, what's interesting about this is the more it goes up in price, the more the market cap goes up, the more financial institutions need to have it. It's also, its price performance also draws more into it. So we've got a very very skewed risk reward, which is why it tends to go extremely fast, extremely far. It's the best performing asset class of all time over 10 years, 5 years, 3 years, 2 years, 1 year, or something crazy. I mean, we've never seen an asset like this before. We haven't yet got the institutions into this. They're all coming into it. I know they are because I'm speaking to them all. I just got off the phone with the largest investment advisor firm in the United States. Their founder is teaching as many investment advisors as he possibly can why Bitcoin. They can't invest yet because there's no ETF. But the moment it comes, these guys have 5 trillion of assets amongst the investment advisor community in the US alone. And if they were to put 1%, 10 basis points in, that's 5 billion immediately. But the chances are it's going to be much more because it's a very fast moving asset. So we've got, I've never seen anything like the skewed risk reward currently in Bitcoin. It's crazy. And meanwhile, the supply can't adjust. And everybody's taking their coins off exchange and putting them in storage because they also expect the price to rise further. So there's literally no supply. Out of the Square Cash app and PayPal, they're pretty much taking all of the mine supply of Bitcoin off the market every day. And then we've got the Grayscale Trust and then everybody else. There's just, the only answer is the price to go up.
Mm-hmm. Is it going to perform similarly versus the euro?
Versus the euro?
Yeah.
No, I think it decouples from the dollar in every way, or the euro in every way. There's passing correlation between currencies. I think it's what's called a Bayesian distribution, which means it has a shifting factors that affect it. So sometimes it trades like gold, sometimes it trades like equities, sometimes it trades risk on, sometimes it trades risk off. But I think overall it's non-correlated.
So we cannot expect the big Bitcoin to reach like 800,000 euros.
Yes, yes. I mean, currencies.
I meant in that terms, yeah.
Yes, absolutely, without question, because the euro can't go, above 150, or could it go down to 80? Yes.
Yeah.
But that the order of magnitude is so small compared to a 50x rise.
Yeah, it is. It is. Can't the institution just ignore Bitcoin?
No. Again, speaking to the financial advisor today, he's like, the problem is all the clients are asking for it. And that is the problem. And I'm sorry, but every day when you get an announcement that Fidelity's in the space and this asset manager and that asset manager, and they get the incremental better alpha, it forces everybody else to do it. So it's as George Soros would refer to them, this is a reflexive loop. It's highly reflective, probably the most reflexive I've ever seen, because almost everybody has a fear of missing out, or in financial market terms, is short call options on the way up. And everybody's forced to buy on the way up. I've never seen anything like it, literally.
Are we about to face major systemic shifts in the relation between fiat money, gold, and Bitcoin in the not too distant future?
I think the major systemic shift that everybody fears is not coming yet, which is, a hyperinflationary total collapse of fiat money. That's the extreme version. I do think that something like what the IMF is talking about, a one-off large devaluation, could happen. That's essentially a Bretton Woods format. It's essentially, when the US left Bretton Woods, we've seen these kinds of things agreeable amongst a League of Nations. That's possible. So, if we do that, well, these assets, gold, Bitcoin, will do extremely well, as will property, as I mentioned it before, and maybe emerging markets. So they're all part of that same spectrum or basket that tends to do well in those environments.
Is the 1 million euro Bitcoin going to coincide with the fiat money collapse?
yes, I'm sure within the next 5 years, we have to reach this grand bargain. So I think it's all part of that. But it doesn't, maybe Bitcoin is just predicting that path, on this nice logarithmic scale, which is also part of Metcalfe's law and this kind of stuff. But maybe, yes, maybe that's what the price is telling us.
Your Real Vision channel just published an extensive documentary analysis on Ethereum. Where does it come in all this?
Well, it's difficult to know because the pace of change of what is happening in the Ethereum ecosystem is extremely fast. Bitcoin, everybody's kind of settled on what it is, and will people develop other applications around it? For sure. Ethereum is like a platform for the future of trust, the exchange of the internet of value. What could that be worth more than Bitcoin in total market cap over time? It could be, I don't know. So I'm very interested in it. I see a huge amount of really smart people involved developing projects there. People trust the ERC20 protocol, stuff like this. People are building tokens there. People are building decentralized finance. It's all happening on Ethereum. There's no one killer thing, but it's not Bitcoin, and everyone gets confused. I don't think of it as a currency. I kind of think of it as a share of a future platform, while Bitcoin, I think of it as a pristine reserve asset, and I just don't think they're the same thing.
We have just read ECB Madame Lagarde's article on the introduction of digital euro following a big Bundesbank virtual conference on the future of payments end of November. Have digital currencies practically become a given fact?
Yes, without question. And the last central bank to do it will be the Fed, because there is a twofold problem that they face here. One is you could get the dollarization of the world, because when you don't have banks distributing money necessarily, and it comes directly from the central banks, and everybody could adopt the dollar. That basically destroys everything. They don't want that. They also want to know what the other central banks are trying to do to create a competitor to the dollar. So they've got this really hard thing, because Facebook Libra let the cat out of the bag, and it was genius. What they said was, we want to create a basket of digital currencies, including the dollar, altogether. Now, if you think about it, we only think of currencies in terms of each other. The dollar against the euro against the pound. But when all the currencies are in a basket, what's the denominator? Well, it's probably money supply. Well, that's an incredibly stable monetary instrument for you and I can promise you that currency, it's going to be stable for you. And if you can agree on what that money supply growth is amongst nations, okay, you've got something extremely powerful. Now, every country will lower the weight of the dollar in that basket. It will not be the 80% that it is now. It has to get closer to GDP. So it's going to be 30, 40% of that basket. That's a massive devaluation of the dollar. So the US is, and a lessening of the dollar's influence, because world trade, it's not just a move in the price, but you're not pricing world trade in dollars. You're pricing in 75% or 65% other stuff. So super interesting, but it is coming definitely without question and faster than we think.
What consequences do you expect?
Who the hell knows? I mean, they already, if you listen to Benoit Cœuré from the ECB and now the BIS, he's telling us that central banks are making the decision, do we just have a simple stable coin? Or do we have smart contracts? Do we have programmable money that he can give you and me different rates of interest or stimulate in different ways? Can they give us students loans, one interest rate? Okay, that's a wholesale change to economics. That's the rise of behavioral economics and a moving away from monetary economics and Keynesianism. Well, it's kind of Keynesian meets behavioral economics, because then you can create incentive systems. So these things are massive. The other question is, does Europe even think it will have a banking system? Because I would imagine the ECB is thinking, well, you know what? Why don't we just nationalize all these things, go to a central bank digital currency and use the nationalized banks as our warehouse that distributes the money. So we don't have to deal with all the public, but we create these and let the fintech layer create the digital solutions. I think that's what's coming here. I think most of these banks will end up being nationalized, and I think the ECB know it.
By the way, why doesn't ECB governor like the stable coins?
Because they are a direct competition to central banks. Because you're creating currency, but it doesn't get touched by the central banks or the banking system. So the Eurodollar market was the traditional way of doing that. So if you in Slovenia wants to borrow dollars, there's the Eurodollar market, and you'll go to your bank, they'll do an FX transact, and it basically becomes Europeans or Japanese banks or whoever could create dollars out of thin air. And now they're creating dollars not in the banking system. And that's terrifying, because then there is no control over your fiat currency, what it's used for and how it's used. And central banks can't do that because governments need regulation and taxation. Now, we may not want that, but they want it.
Yeah. The whole idea seems to me like merging monetary and fiscal policies.
Totally agree.
Do you see any legitimacy issues with that? Because ECB, of course, is a bunch of elected people running the whole thing. I don't see European countries coming to the same platform.
Find me another answer. That's the problem. I ask this, I turn it round and say, okay, fine. What's the other answer? And I haven't got one, and most people don't either. So they go this way, and it doesn't go right. We know, because you still have to increase debt. We're not stopping any of the issues. We're still devaluing fiat currency, but what you've created, and you're using, and you may be able to help people get out of this crisis, and it might work for a time, but then the same problem still surfaces. You've now got you've now got rid of the problems of the banking system, but the problems at government level and central bank level. So that is what Bitcoin is all about. It's the life raft. It's the way that you and I can say, you know what, we're not comfortable with this anymore. I don't want to hold euros or dollars or pounds. I'm just going to hold Bitcoin, and we can just step out. And because I don't know how it all ends, whether we have to have a giant debt jubilee, start all over again, create something different, but something will happen in the end. And I don't think that end is too far away. So it's nice to have something like Bitcoin. I was postulating over the weekend about the idea that what happens if they created this central bank digital currency, but the basket version?
Yeah.
And what happens to be a member of that basket? You're restricted to 2%. You're allowed the 50% increase in money printing to get out of the crisis. And then the only way you're going to do it is to agree to a 2% increase in money supply only. So then you've got a central bank digital currency that looks like Bitcoin once it's been devalued. Okay, that's interesting. Now, can you then, you will have inflated your way out of the debts because you've devalued by 50% essentially. Those kind of things, they're possible. And then maybe you wrap all these debts up and issue a perpetual bond at 0% interest rates. So there is ways out, and it's not going to be a hyperinflation, everybody having to eat grass in a field because there's no food to live on. It's not going to work that way. There are other ways to answer this, but they're going to take a crisis for people to do it.
You're going forward. Your sense-making channel, Real Vision Finance, recently held a big web conference called The Aftermath. Looking 3 to 4 years ahead, what kind of future was it painted there?
Well, there was a mixture between these kind of issues with, okay, government policy, the rise of populism, and all of these issues we're still facing that haven't gone away. So there was a lot of concern, but then we talked about India, Africa, cryptocurrencies, commodities, precious metals. Many of those things have great opportunities. You know, if you and I have talked about in this interview, there are opportunities. It's not like nothing is an opportunity. I think there's a great opportunity to be an entrepreneur. Starting a business in a crisis is a very good time to start a business. I think entrepreneurship is still, particularly in Europe, still not fully understood. And I think that the more people take control of their own lives in that way, it's good. So it is a bifurcated world. It's a bifurcated world of this mess of central banks and debt and everything else, but we can invest elsewhere. You know, we know we're going to get probably another commodity cycle at some point. We've got the precious metals, we've got cryptocurrencies, and then we've got an incredible opportunity in emerging markets.
Let's assume the 2021 vaccine deployment is successful. Debt and deflation take over the news cycle. Where do we go from there, according to your most likely scenario? And how long before the economy sees the beginning of reflation?
Yeah, look, I think the market will try and price in reinflation. It's already tried once, and I think this reinflation bet will fail. I think we'll see. I could be wrong, but I think from Q3, Q2 next year, we'll start to price in more reinflation, and then we'll see the economy. I think will be slower to reinflate. We will see some measures pick up. I don't believe in massive inflationary pressures growing in the system. I think aging populations, debt dynamics, and behavioral scarring from what's just happened. I think, you know, as you said, as we talked about in the beginning, people increasing their savings rate. I think that they're not going to throw it all in and buy stuff on Amazon. So I think, you know, we've seen every crisis, the trend rate of GDP growth keeps falling. I think this will be the same. So where is GDP growth after this? 1%. Now, will you have a period where you get a pickup for 6 months? Yes, but overall, I think it settles at 1%.
Which data series to look for to be ahead of the curve?
It depends on what you're looking for. If you're looking for the economy right now under current conditions, you can use the Google mobility data, and that gives you an idea as how much the economy picking up or not. But longer term, I use the PMIs, the PMI data. It just gives you a decent monthly read on roughly where you are, the year-on-year rate of change, because GDP growth basically tracks that. Or you can choose any version of it, whether it's the Zoo survey in Germany or whichever one. They basically will all roughly work across Europe. Sure, there's different countries have different cycles mainly, but that's what I'd be looking at.
Well, thank you so much. Yeah,
thanks. Enjoyed the interview. It was fun.
Yeah, thank you so much. Looking forward to the next time. Bye-bye. Thank you.
Take care.
Bye.